Accounting terms can be very confusing, can't they? Yeah, I get it. Hi, this is Judi Otton with Growthcast, and I'm here to explain three very common accounting terms that I want you to understand. And I'm going to tell you why these three are very important. The first one I want to talk about is accounts receivable, also known as AR, and you will see this abbreviated as A/R. This is the money that is owed to you. Now, when you do work for someone, you probably send out an invoice, and for many business owners, that's the end of that process. But if the customers don't pay you, those receivables age, get older and older and older. And it's great to make sales, but unless and until you get that cash in the door, it doesn't mean anything. So you may have heard of aged accounts receivables or not over 90 days accounts receivables. These things are not good. It's good to have receivables, which means people owe you money, but you want to keep on top of this. You don't want to let this age too much. And the good news is that this is very easy to get under control. You know that saying, you can catch more flies with honey than you can with vinegar? Well, that applies here. When you see that customers are late in paying, just give them a friendly call. Hi, Mr. Customer, just wondering when we can expect our payment. And keep at it pretty consistently every week or every other week. You may want to alternate calls and emails because different people respond to different methods, but you don't want to just let this one go. You want to keep an eye on your accounts receivable and make sure that it stays as current as possible. The second term that I want to talk about is break-even point. Now, bear with me because this is going to be a little bit hard to explain verbally, but there's a visual right here. So grab this if you want to see this depicted on a piece of paper. The break-even point is the amount of gross profit that you need to cover your fixed expenses. So remember when we talked about the P&L, there was income, there was cost of goods, and income minus cost of goods was gross profit. And then you had all your expenses. So you want this gross profit number to be larger than your expense number, because otherwise you're losing money. You can even work backwards to see what you need in sales to cover your fixed expenses. So this is important, especially as you're growing, as you're starting up, as you're growing, or if you're coming out of a rough time with your company. You really want to know, what is that break-even point for me? The third term that I want to talk about is return on investment. If you're doing anything new in your company, you have a new project or a new initiative, or let's say you want to automate a piece of your factory or automate a piece of your business. What is the return on that investment? You're going to invest $10,000, $100,000, maybe $1 million into your business. You want to know that you're going to get a return on that. Are you going to have labor savings? Are you going to be able to increase capacity? Are you going to be able to increase throughput, or the time that it takes you to make an item? So what is the return, and how long is it going to take you to get a return on that investment? Because if there is no return on that investment, as cool and as exciting as that project might sound, it's going to cost you money in the long run. You're not going to make any more money because of that. If you have questions about these or any other mystifying accounting terms, feel free to reach out to me, and I'll be back next week with another fiscal fitness tip of the week.